Good afternoon. As we have continued to onboard new clients and we're going through that process, we see a lot of common errors that are taking place, a lot of common practices that we are seeing with those new clients as we are onboarding them. So I thought it would be important to come on and share those with you so that you can take the time to review each one, see if you can see some of the similarities in your own business, go back, talk to your accounting staff, see that they're on the right track in these areas, and make sure that you have the proper processes in place. So I will just start with number one, and something that I've been dealing with today with a client is a lot of companies are using a mix of accrual and cash basis accounting, and it's not very consistent. So we may see that they are you're supposed to be doing an accrual basis for their books. Maybe they do a cash basis for their tax return, but they're kind of doing really a mixture of the two on their books. So they could be, when they record an invoice, it's being booked as revenue, which is on an accrual basis. Same with accounts payable and sending out invoices, receiving invoices from vendors, also reporting those on an accrual basis. And so we have accounts receivable, we have accounts payable, we have retention on there as well. But then we shift over to the income statement and we are seeing that there are no prepaids getting booked. They might have a large insurance payment that they pay at the beginning of the year and they're not breaking that out over the 10 or 12-month period that they need to be. Maybe they get behind a month on rent or they decide to pay ahead a month on rent and they're not taking that over the appropriate periods that are being paid. Instead, it's all getting dumped into one lump sum. So that's where you see a lot of fluctuations on the net income, and you'll see a huge profit one month, a huge loss the next month, and you're like, what is happening? I can't predict what is going on with my business because it's so hit or miss and up and down. And it's because we're not being consistent with the way that we're accounting for our revenue and expenses. And that's one of the most important things is consistency. And we find that most bonding companies and banks really want to see the books on an accrual basis, especially in the construction industry that we're in. So the second piece is on interest expense. And when these companies are recording their loan payments, they are taking the interest portion on the balance sheet as well. So if they have a loan on the books and they're writing a check for a payment, let's say it's $2,500 payment and 500 of that is interest expense. So they are taking the full payment to the balance sheet account instead of breaking out that $500 and adding it to an interest expense account on the P&L. The third area is that depreciation expense is recorded annually. And this isn't really a huge problem. I know that a lot of smaller businesses do this. Their CPA that they have prepare their tax returns are also making their depreciation adjustments, so it's not being done monthly. So at the end of the year, their CPA will do their taxes probably in March or April or later, and then they'll go back and book that depreciation expense. But you're not getting a true picture of where your financials are on a month-to-month basis when you do that. And your financials could look really good, profit could look really good, and then you send them off to the CPA to do your taxes, and bam, they've changed, and you're in the hole. And you're like, what happened? So if you have the ability to record that depreciation on a monthly basis, or at least an estimate of the depreciation, you can always have your CPA run a monthly depreciation schedule for you so that you can go ahead and record those on your own each month the following year. Okay, so number 4, job costs are recorded to indirect cost accounts or overhead cost accounts. So this is a big one that we see a lot, and we spend a lot of time adjusting these accounts out. They don't typically have their job costs consistently going to job cost accounts. So It could be fuel, it could be certain labor, something gets all lumped into shop and it should be job costed out. Um, it could be going to an overhead cost account, or all their payroll is going to one big payroll line item in their overhead costs, and it's not breaking out those direct payroll hours and the indirect payroll hours. It just makes it very difficult to produce an accurate WIP and really know where your jobs are and how your business is operating. Part of what kind of goes into that is my number 5 with tools and equipment. And once those are owned, a lot of businesses aren't going back and costing those out to jobs. So in the beginning, when you first start your business, you don't have any capital, you don't have any money to go buy big pieces of equipment, you're renting them. You're renting the equipment, you charge them back to the jobs, you're really able to track and see what costs are on those jobs. As you grow, as you get more capital, you tend to go buy your own equipment. And then when you do that, you're not accounting for that piece of equipment on your jobs. So I come and I talk to you and say, hey, what's going on? Well, my cash is low and my jobs are doing great. My jobs are making a profit. So that's not the problem. It must be overhead. When actually it's these equipment costs and these small tools that you aren't taking back to your job sites. And number 6, costs are getting entered in months that are already closed or in periods that are already closed. So it may be that a PM lost an invoice on his desk for about 3 months and it didn't get entered. And so you already closed that month, you're like 3 months down the road and they turn in this invoice, and then you go and just, or someone in your accounting team goes and enters it from 3 months ago. You maybe have a billing that you issued and they come back, the owner comes back and says, no, we're not going to accept that. We need you to change it. And it's from 2 months ago, the billing is. So they're going back to those prior months and entering those costs and entering those billings and making adjustments. They're behind on credit card receipts. So there's no good process for closing the month down. And when you look at it and you think you have good numbers, and then in 2 months, all those numbers change. It makes you have to spend additional time, additional money to make sure that you have accurate financial reporting. So there needs to be a good process in place for closing the period and not going back and entering old information. We need to just keep moving forward and enter it in the month that we're in. So I hope that those 6 areas help, that you'll be able to go through and kind of see where your business is in those areas, talk to your accounting department, make sure there's processes in place. And if you feel like you could use some little help there and you're not really sure where to even begin with it, give us a call. We'd be happy to help you and walk through some of these areas with you. So we are going to go live every day this week. And at the end of the week, on Saturday morning, we hope that you join us for coffee or tea or whatever that is for you. And we're going to do a live Q&A. So bring your questions. We're here to help you. It can be specific to your business in the construction industry. And we're going to do our best to answer those. On Friday, we'll go through some examples of some questions that you might answer or might want to ask, some areas that you could be focusing on, and hopefully if you're able to watch each of these videos leading up to it, it'll kind of spark that interest in some topics that might be in your mind. So please join us on Saturday, and please like and share this with anyone that might find it helpful. So thanks for listening.